right, dear students, welcome to Chapter 17. You know, Chapter 6 was pretty intense, wasn't it? For lack of a better word. Well, Chapter 17 is actually much less so. In fact, the calculations are pretty straightforward and trivial. They're ratios. But this is important stuff, folks, because the more you understand the world of accounting, the better you are to understand at least what the companies are reporting. Doesn't mean it's the truth, but that's a separate issue. Chapter 17, Projecting Cash Flow and Earnings, Financial Statements and Ratio Analysis. Chapter 17 deals mainly with financial statements and ratio analysis. And we're going to look at all the ratios, but you don't have to compute all of them because once you've done a few, it's pretty straightforward. You just got to find the right numbers. And then you have to compare them to companies that are similar to the company you're researching and to the market as a whole. So it can be very involved, but it's pretty straightforward. And then we've already done a little bit of forecasting, so we're going to skip that. So if you're running through the chapter, you can eyeball the forecasting. And what I mean by that, just look at the financial statements and look at the quarter over quarter or year over year results. It can be very illuminating. You get a big picture and then you zoom in on individual numbers and individual ratios. So I hope you enjoy this. I do. Not as much as I enjoy Chapter 6, though. That's my favorite. Let's get started. Slide number 2, financial statements. Now, don't relax. If you've taken accounting, we're not going to do any balance sheets, trial balances, journal entries. No. That's all done for us. Done for us by the accountants. Thank you very much. But the more you understand accounting, as I mentioned, the more you'll understand what the companies are reporting. And folks, if this piques your interest, we have dynamite accounting professors here at Southwestern. Far better than the financial professors, one in particular. But in fact, one of our accounting professors, Maria Martinez Sanabria, won the Teaching Excellence Award, Best Teacher of Southwestern Community College a few years back. Now, how often have you heard of an accounting professor who is adored by her students and wins a Teaching Excellence Award? Yes, no, it's very, very infrequent. And so we're just going to use the financial statements. And the 3 financial statements that every publicly traded corporation must produce every quarter are the balance sheet, the income statement, and the cash flow statement. If you've taken Business 121, Financial Planning and Money Management, we created a cash flow statement, but as we discuss in that class, the accounting professionals cringe when we call our cash flow statement a cash flow statement because it has nothing to do with the statement of cash flows that is done in a real accounting situation, but it works for our situation. So let's take a look at each one in detail. Slide number 3, the balance sheet. We called it in the financial planning class the net worth statement. We take our assets, right? We take our assets and we list all of them. Anything that the company owns that has value. And then we list all our debts, all our obligations, liabilities. And then we in the real world just say assets minus liabilities equals equity, but that's not the way the accountants think. They say assets equals liability plus equity. And why do they do that? Because the two of them must balance. The assets, total assets, must be equal to the liabilities plus the equity. And so they used to call it, they called it a balance sheet because they used to have a sheet that was turned on its side, and then they have the assets on the left side, and then they have the liabilities and the equity on the right side. They don't do that anymore. They just list them in an order down the sheet, assets, liabilities, and then what's left over, the equity. The accountants break everything into current versus long term. which we don't normally do in the financial planning class and in investment class. For us, we think of short term, intermediate term, and long term. For them, current means short term, anything 1 year or less. Anything above 1 year is long term. So that doesn't quite jive with the finance and the investment community, but that's okay. And in the face-to-face class now, we would run on over and take a look at a balance sheet. And we happen to be using Ford's balance sheet. So let us take a look. Now, bear with me. Make sure I don't, mess this up. Here it goes. It's a balance. There's the balance sheet. Cool. Okay, got it. And we can't see the whole thing because it would be too small if we did. But we're taking a look at the annual balance sheet. Annual. You can also download the quarterly balance sheets, and they're available on the Yahoo and Google and Bloomberg. No, actually, I couldn't find them on Bloomberg and other websites. Or you can go right to Ford's website and ask for them, or just call them up and ask for them. They'll send them to you. And so what we're seeing, we should be seeing 2016. Maybe you can't see it if you're looking at the on a small screen, but it turns out at the end of December 31st, 2016, at the end of 2016, they had almost 15,905,000. No, actually, no, folks. These numbers are in thousands. They had almost $16 billion in cash or cash equivalents. Those are big numbers, folks. And then, look, they had almost $23 billion in short-term investments and over $57 billion in money that was owed to them, mostly the dealerships selling the cars. They had almost $9 billion in inventory and a little over $3 billion in other current assets. So they had total current assets of $108 billion. That's stuff that's used within a year. And then, look, long-term investments, property, plant, and equipment, other assets, deferred long-term asset charges. What's that? That's why we want to learn more about accounting. The more we know about accounting, the more we can understand these numbers. And they had total assets of almost $238 billion. Okay, what are the liabilities? Well, look at the current liabilities. Those are liabilities that are due within a year. Accounts payable, let's see, they don't make most of the stuff they slap together into a car. They have to pay for those things, the airbags and the air conditioners and the like. They don't make those stuff. They buy them from vendors. And then they have some long-term debt that is coming due, almost $50 billion, plus some short-term debt that's due. And then over 19 billion in current liabilities, other current liabilities. So they owe over $90 billion, which to you and me would be enough to give us a heart attack. But remember, they've got over 108 current assets, so they can pay their bills. And we'll take a look at those ratios later on in the second presentation. Then there's their long-term debt and their other debts, other liabilities. So $208 billion is owed by Ford. So what's left over? Assets, 238 minus 208 gives them about a bunch of over $20 billion in stockholders' equity. And you notice some of these numbers are negative, and there's a reason for that you would learn in accounting class, and we're not going to go into now. But you see, it's not hard to read. You have to dig deep. You have to find out what treasury stock is, what other stockholder equity in these are. But you're going to do that. You're going to ask questions when you investigate, if Ford is one of the companies you investigate. Okay, so let's now, and then you're going to compare that balance sheet, right, to GM and to Toyota and Honda, right. You can't just look at one company in a vacuum. You have to take a look at their competitors, right. So now let's get back to the presentation and now take a look at the income statement, which is the difference between a company's revenues and expenses. And so we take the revenue, the income coming in, the money coming in, we subtract out the expenses, and then we have a choice. We can either pay that out to stockholders, or we can keep it. And we can do both. We don't have to pay all of it out in dividends. And those of you who have taken accounting, remember retained earnings. Right, any money that the corporation keeps and doesn't pay out as dividends becomes retained earnings. which are normally used to upgrade the company to finance future growth. This is what in the Business 121 class we call the cash flow statement. And when we do that, the accountants cringe. The accountants don't like it when we call that a cash flow statement. Hey, but it works for the financial planning class. The cash flow statement, or the statement of cash flows, is something different that we'll take a look at in a bit. But first, let's now take a look at Ford's income statement. And again, we're only showing the last year. When you take a look at it on the website, or go look at it on Yahoo or Google or one of the other websites, you'll see that it shows you the past 3 years, 2014, 15, and 16. And so last year, the total revenue, sometimes called the top line. See, some of you listened in on those earnings calls and you heard top line growth, bottom line growth. And what the hell are they talking about? Well, here's what they're talking about. Here's the top line. This is how much money Ford took in last year. Almost $152 billion. But they had to spend a lot of money to make those cars, folks. They don't, it takes a lot of money to make a car. And so they paid out $135.5 billion in what is called the cost of goods sold, or cost of revenue. And so they're left with a gross profit of $16 billion. But then there are operating expenses. And remember, I asked you to look what SG&O means, and you hear these people on these earnings calls using that term SG&O, and you're thinking, what are they talking about? Well, those are everything. Those are the keeping the lights on, and the marketing, and the administrative costs, all that stuff. And so they, and they usually separate out the research and development, but Yahoo, for some reason, is just throwing it all into one number here. So that is the operating expenses. And so now, after we've deducted the cost of goods sold, got the gross profit, deducted the operating expenses, we get the operating income, and if it's in parentheses, it's a loss. But Ford's been making money, folks. It's wait till the next recession. And then we have these other items that we have to deal with: earnings before income and interest and taxes, interest. Income before tax, income after the tax expense. You got to pay. Ford paid $2 billion in taxes last year, and then we're down to net income from continuing operations, and then finally these non-recurring events. These are things that are extraordinary or anything that had to be written off. You might have heard that phrase, written off. And so Ford last year made $4.5 billion in net income, net profit. The bottom line. Do you remember that term? The bottom line? The top line is how much money came in the door. The net income is what you got to keep. Right. So wouldn't you like to have made $4.5 billion last year, right? So would I. But anyway, that's Ford. And maybe we're going to invest in Ford. Who knows? So let's go back to the presentation now. You play with it. Take a look at the income statement. See what you can understand. See what you can't. Know that you got to do a little bit of investigating. And no, I'm not trying to turn you into an accounting major. All you have to do is understand it. Let them do the work for us. Okay, so now let's get back to the presentation. And as we've said before, as we've mentioned before, some income, some expenses are not always received or paid in cash. Huh? Well, remember depreciation? Right. That's why there is the cash flow statement. So let's now take a look at this. First let's take a look at the slide. The statement of cash flows is the name that you'll hear more refined accounting individuals say, but most people call it a cash flow statement, and it's not the same cash flow statement we did in Business 121, Financial Planning and Money Management. In essence, the cash flow statement is saying what happened to Ford's checkbook. What money, other than what we saw in the income statement, came in the door, what money went out the door. How did the checkbook get changed? And as we said in one of the previous presentations, some companies were getting record earnings, and the checkbook was going down. How can that be? Well, that's why you have to take a look at the cash flow statement. And that gets a little trickier. You're going to have to do some digging, folks, to figure out what these things mean, because some of them are a little tricky. But essentially, we're saying, look, the first thing we're going to take a look at is depreciation. That's the first line, well, not the first line, but the second line on the statement of cash flows. And then we have to understand that these companies are large. They're doing financing. They're doing investment. They're doing other types of cash flows. And so we have to take a look at that. So let's take a look at Ford's cash flow statement. And notice where it starts. It starts where the income statement ended, with the net income. And says, okay, now, let's see what else, let's see what happened. And look, as I said, the first line, well, I meant the first before net income, after we put down the previous number. Here, depreciation, there's the bad boy right there. Nobody in Ford wrote a check out to depreciation, but they were able to reduce their income by $717 million, almost $9 billion, so they didn't have to pay taxes on that. So that was an accounting expense. But they still got the money. It still came in the door. So we have to add it back in. And there were some adjustments we have to add. And then some adjustments we have to subtract and add and so forth. And so this is what happened to their checkbook. They actually got in an extra $20 billion from operating activities. I'm sorry, not extra. That includes the $4.5 billion. So almost $20 billion came in the door. But another $25 billion left from their investments. They got some money from investments, and then they paid out some money for investments, and almost $7 billion in just capital expenditures. They say, we're going to build a new plant. Well, that thing doesn't come cheap. And so there they are. And then there were financing activities. Remember the dividends paid? Right, exactly. They didn't get to expense the dividends, folks. That's not a taxable expense, but they still, that money came out of their pocket. And that's the only number that's real. There it is, folks, because they paid that money to the shareholders. And then they borrowed some money, and so they got an extra $7 billion from financing activities. And it turns out that even though they made $4.5 billion in net income, and then added another several tens of billions of dollars, tens of billions of dollars also went out the door. And it turns out their checkbook went down by a measly $265 million. So in other words, their checkbook didn't change that much, and hasn't changed. They're a pretty sharp cookie. They're a good company, huh? They know what they're doing. They know they need to have enough cash on hand, and so they balance it the best they can. And then sometimes when the economy's really screaming, car companies make a ton of money. They get all this cash in the door. And then other times when there's a recession, car companies are starving. It's a cyclical company. So that was the statement of cash flows, and I spelled effect wrong. I got to fix that. Play with them. Take a look at the companies that you like, that you did your research in Chapter 6, and then get a better appreciation of what's going on in their finances with the accounting statements. You can do it. I have confidence in you. And then maybe you'll bite the bullet and actually want to take an accounting class. I wish you a lot of luck. I took accounting a long time ago, and I don't want to take it again. All right. Get out of there. Okay, so let's get back to the presentation. Now, where do these financial statements come from? Well, the requirements, the responsibilities of a publicly traded company are that they must report these financial statements along with a lot of other stuff every year in their 10K annual report, and then their 10Q, their quarterly report. And I already played this joke on you, but 10Q, you're welcome. It's a sickness. I can't help it. And it used to be, and you should read one of these, folks, you'll never get through the whole thing. You'll fall asleep. They're great for insomnia. The first few pages are the most important, then you got to dig deep for other pages. And a lot of it is it's ridiculous legalistic stuff that the lawyers make them put in there. And some of you can get through it. I wish you a lot of luck. But it's good for insomnia, as I said. And it used to be that individuals on Wall Street, people in the sometimes some in the mutual funds, some in the investment bank and the like, they would be able to get this information before everybody else. Well, not anymore. The Securities and Exchange Commission says everyone must be given this information at the same time. And that is what is called the earnings call. And that's why in Chapter 5, I asked you to do an earnings call, whether you, made it for the actual day and time of the call, or you went back and looked at what they presented. Because at that date and time, that's when those financial statements are uploaded to Edgar, is the name of the database, and then everybody has access to them. And that's when the CFO, the CEO, and then maybe another individual will go through and discuss the quarterly earnings, the yearly earnings. Cool. And so it makes sense. It does make sense. It should be fair. And there are countless other sources for information. I've heard many investors opine that nowadays there's simply too much information. And I love this statement from a gentleman by the name of Nick Murray. Wisdom sold separately. And he's right. Yeah, there's too much information. It's overload. How do you boil it down to something that makes sense? Well, it's difficult. And we're learning techniques that help us, but you never see the whole iceberg. We, as real retail investors, are just seeing the tip of the iceberg. We're just seeing the top. And that's why, some of our times we're going to make a mistake and the professionals, they see more than we do, but not a whole lot more than we do. You really have to be intimately involved with the company. And then a company as big as Ford or GE or Microsoft, you still don't see the whole company unless you're in the CEO's office. That's the nature of the beast. Slide number 7. So let's get back now to financial ratios. We've already done some ratios, and in fact, we're going to review. We're going to review the ratios we've already gone through. And in our next presentation, we'll actually dig into the financial statements and do some calculations. In this case, we're just going to review these. Financial ratios. That's the relation between two financial quantities expressed as the quotient of one divided by the other. That's what the definition of a ratio is, folks. And then ratio analysis is the study of the relationships between financial statements accounts. So if you remember, I want you to recall that there's no one ratio that can accurately sum up the overall general state of a company. You can't just look at one ratio. That's it. That's the reason I'm going to buy or sell this company. No. Each ratio must be considered in the context of all the information gathered. Plus, you must also consider any ratio in the context of the industry the company exists within, which is a fancy way of saying you got to look at their competitors. And we're going to see an example in a few slides. So here are the common stock ratios, sometimes called the market ratios. And we've already gone through these, right? We've looked at the PE, the dividends per share, the dividend yield, the payout ratio, the book value, the price to book, the price to cash flow, the price to sale. The one we haven't taken a look at is the PEG ratio, which is it's pretty straightforward. And these ratios, and we'll take a look at that in a few slides. These ratios use data from both the balance sheet or the income statement or both of them. So these are things that we've already taken a look at, and some you've already looked them up. You've already computed a few. You've compared price to earnings ratio, dividends yield, dividend payout ratio, and they're pretty straightforward, right? So let's go back and now review PE, price to earnings ratio. This is arguably the most popular stock market statistic. This is the one that people will key on when they're looking at the individual stocks that they're interested in or the market as a whole. And historically, PE ratios were in the 5 to 12 range for mature companies, 14 to 20 range for greater growing companies. But greater than 20 was unusual. But there were a few times when it wasn't, in the 20s, late 20s, in the 60s, and then early 70s. Today, it's commonplace. The PE ratio also tells you how long it will take in years, assuming no change in earnings, for the company to earn back its price. So if it's a PE of 3, it's going to take 3 years to earn that money to pay for the price. 20 years. And people say, well, why is that important? Why? It's not. It's not really that important. I mean, it's not something you should use to make or break your decision, but it's just something to think about. It's just something to think about that I like to. I guess I should take it out because some people they go, oh, well, what does that mean? Well, it means, if nothing else changes, and it's changing all the time, the price, the earnings are changing all the time, it'll take that many years for it to earn back its price. So take it for what it will. It's not that important. Slide 11. Okay, so now let's take a look at various companies that have absolutely nothing to do with one another and their price to earnings ratios. So you've heard of all these companies. Maybe you haven't heard of Amgen or maybe Merck, but ExxonMobil, energy, Facebook, right, technology. Amgen is a biotechnology company. And then JP Morgan is a bank. General Mills makes Cheerios, and Merck makes drugs. And you look at these things and you say, what's going on here? How come energy is so high? Technology, well, you'd expect that to be high, but biotech, shouldn't that be high? I don't understand. Banks are low, are they really? And then that's, kind of average for now, because PEs are pretty high in general. And then, wow, the drug company is really 35. That's pretty high. Well, as we said, and we're going to say over and over again, we have to look at our competitors. We have to look at companies that are in the same industry to get a feel for what's going on. And then when we see something that's way out of the ordinary, as we're going to see on this slide right here, as we already see on this slide, then we can say, oh, okay, that makes sense, or no, it doesn't make sense. We need to do more research. In the case of the energy companies got hammered about 3 years ago, 3-4 years ago, about 2.5 years ago, when the price of oil simply plummeted. Why? Because the Saudis started pumping out tremendous amounts of oil to knock the price down, to put the fracking industry out of business. And a lot of companies have folded, but not too many, and not as many as the Saudis would have liked. And the energy companies are starting to recover. They had just gotten clobbered. Well, what's going on? Well, investors are seeing finally, here ConocoPhillips is still losing money, but BP and Chevron and Shell are back in the black, so to speak. They've started to make money. Exxon, I don't think actually lost any money, but their earnings, all of them got hammered. If you take a look at their income statements, and we didn't look at this, we didn't look at any of these companies, but if you look at their income statements from 2012, 13, 14, 15, 16, you just see it fell off a cliff. So they're coming back, and investors are anticipating that. So they've bid up the price accordingly. Now ConocoPhillips is eventually going to start making money again, but right now it's still negative. That's why you often see NA for not applicable. But in reality, when the earnings go negative, the price to earnings ratio goes negative. So their price to earning ratio is a negative 15.4. You don't normally see that, the negative PE, but sometimes you do. Okay, and then let's take a look at Facebook. Well, you'd think, technology companies, Facebook and Google, 38, 36, because they're the exciting, a new thing.
I don't understand.
My phone is talking to me. Go away, phone. Because I said, okay, let's take a look at Google, and it said, oh, you wanted to talk to me. Speaking of Google. And so, but look at Netflix and Amazon. Whoa, what's going on here? Oh my goodness. Yes. Investors are so excited about the prospects for Netflix and Amazon that they have bid up the price relative to the earnings to astronomical amounts, folks. Look, I think they're both great companies. Really, I do. I mean, personally, I don't have a television in the house, and I won't. So I don't care about Netflix. But Amazon, my son, that's what he does. Everything he buys is from Amazon, not me. But that's not. I'm weird. What can I say? And so people believe that these two companies are going to go straight to the moon. Now, what happens if they don't? Exactly. The parachutes had better be very large because they're going to fall like a stone. And this has happened to Netflix, I think, twice, where they've lost way over 50% of their value and then come back. So, hey, it's not new. Now, what's going on with Twitter? Twitter. Yeah, they're NA, right? They're losing money. So far, they haven't found a way to make money off of Twitter because nobody wants to click on their little ads that they throw on your screen. I don't know. I don't use it, so I can't relate. But in the case of Facebook and Google, yes, people click on the advertisements, and that's how Facebook and Google make money. And people think, well, how do they make money? They make money off of you. Because both Facebook and Google want to know everything about you so that they can tailor the ads to you, because every time you click on one of the ads, cha-ching, that's how it works. So do you think Netflix and Amazon are going to take over the world? Oh, maybe. Who knows? We'll see. All right. Now, what about the biotech world? Well, Amgen trades for a respectable 17, which in these days is pretty average. Biogen, which is another biotech company, Biogen IDEC, at 21. A little bit more excited are the investors. But look at Illumina and Celgene. These are two biotech companies that we would list as speculative. The technology, folks, I'm telling you, the biotech world is going to make what the computer world did look tame. And here are two companies for which the future looks bright, at least as far as investors believe. Now, are they correct? That's the big if. And if they ain't correct, again, the price is going to drop and people are going to be burned. But that's the thing about hot stocks, so to speak, speculative stocks. Now let's jump down to the food world. Not too much exciting. People are kind of excited about Kraft and Heinz and Kellogg's. Yeah. Not so much with General Mills and Hormel. Hormel is the company that makes Spam. If I were Hormel, I would have an email campaign and I would say, this is Spam. I don't know. They probably thought about it and thought it was kind of dumb, and so they haven't done it yet. What about the banks? Banks are supposed to be boring. That's the way they were for dozens of decades until deregulation. And banks got very exciting to the point where they were gambling with our deposits, and they lost hundreds of billions of dollars, and we had to bail them out. And supposedly there were going to be great regulations to keep that from happening again, and Dodd-Frank is not very good regulations, folks, and it's going to happen again. Someday the banks are going to have to be bailed out, the two big to fail banks. Supposedly it's not going to happen. Ha, 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 ha. You better believe it's going to happen. So write your elected Congress bozo and tell them you want the banks to be well regulated, because if we don't have banks, we don't have a modern economy. And he or she will say, thank you very much. We're not going to listen to you. We're getting too much money from the banks, so we're not going to listen to you. Anyway, but banks are boring again for now until they aren't again, and then we're in trouble. And then the drug companies, this is what you'd expect, right? The drug companies all over the map, but really high. Pfizer and Bristol Myers, in the 20s. But hey, Merck and Eli Lilly, the investors are more excited about the prospects for these companies. So, what's the takeaway? You cannot just look at the price to earnings ratio or any of these ratios that we're going to cover in this chapter in a vacuum. You have to look at the competitors and see how they relate to the company you're interested in and the market as a whole. And as we've said already, and we're going to say again, you can't just look at one ratio. You have to think of it like a stew and look at all the ratios in relation to one another. Cool? Okay. Slide number 11. How can we account for the wide PE disparity between different industries and different companies within industries? Well, it all gets back to the expectation of future earnings and, if the company pays dividend, future dividend growth by investors. And this is a quote from a random walk down Wall Street. You probably, if you're looking at a small screen, you can't read it. I apologize, but I'll read it aloud to you. Take a nice little company that has been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's market, which was the 1960s, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth Burners, which no one understands. A word that no one understands entitles you to double your entire score. Therefore, we have 6 times earnings for the shoelace business, 15 earnings for the electronics and silicon, or a total of 21 earnings. 21 times earnings, 21 PE. Multiply this by 2 for the word Firth Burners, and we now have a score of 42 times earnings for the new company, which used to sell shoelaces. This is Jack Dreyfus, who founded a very large mutual fund company called the Dreyfus Funds. The technology changes, so now it's nanotechnology, 3D printing, silicon, replace electronics and silicon with social networking and China. Indeed, there's a company in San Diego called Nanotech. And this was a few years back when nanotechnology started to make it into the mainstream media. And you heard people talk about nanotechnology, so investors thought, oh, I got to go buy some nanotechnology company. And there was a company called Nanotech. That must be one of them. And so their stock started levitating. And nobody understood why. And the company said, we don't know why. And everybody just figured it had to do with the fact that people all of a sudden decided they had to own a nanotechnology company. Yeah, there's an awful lot of silliness going on, folks. That's why you, as a prudent long-term investor, should do well. Slide number 12, the PEG ratio. Now, this ratio we haven't looked at. We took quite a bit of time on the PE ratio, and that's important. And you're going to learn the subtleties of PE, earnings, and then and then price, and how they relate to one another. And now the PEG ratio is just taking it one step further. We said that traditionally a PE ratio would match the growth rate. And so the PEG ratio is just trying to see if it does. So you take the PE ratio and you divide it by the growth rate of the company, 3 years, 5 years. And of course, you don't know if that's really what's going to happen. You're just guessing. But if you have a PE ratio of 1, that means the PEG ratio. If you have a PEG ratio of 1, that means the PE ratio divided by the earnings is equal to 1. So if it were 20 PE, 20 earnings, earnings growth rate, then you'd have 20 divided by 20, or 1. If the ratio were higher than the growth rate, then the PEG ratio would be higher than 1. If it were lower, then it would be lower than 1. And so you were shooting for a ratio of 1, but nowadays it's a hell of a lot higher. So some people might say stocks are just overvalued, and they may be right. And in some cases, I'm sure they're right. In other cases, maybe not. It depends. Every company's different. So check out the PEG ratio. If you like it, great. It just tells you whether the company's PE matches the growth rate. And if you don't like it, don't use it. Then dividends per share. Oh boy, slide 13. Very important, very important. We spent a lot of time on dividends, right? Yes, and we love dividends. And so we take a look at the annual dividends paid to the stockholders and divide that by the number of shares outstanding. But we don't have to do that. We just look it up on Yahoo or Google. Remember, Google, you get to multiply by 4 because they show you the quarterly dividends. And as we discussed, dividends became taboo during the 1990s. But now, dividends can be discussed in polite company again. Right, because dividends don't lie. And as we said, that's the one number that you know is absolutely true because they had to write a check. But they don't do that anymore. It's all electronic. Slide number 14, the dividend yield. We did it in Chapter 5, and we looked it up, and it's very straightforward. How much is it paying us on a percentage basis? Take the dividends per share and divide it by the price of the stock. This important statistic allows an investor to compare a company to other forms of investments, such as savings accounts or bonds. Traditionally, 4 to 6% was considered pretty good, and then now 2.5 to a little over 2% is what the S&P is paying, the 10-year Treasury is now paying over 2%. I have to fix that. And savings accounts are still yielding far less than 1%. Some stocks are paying much more, as we saw. Some companies pay pretty 3, 4, 5%. And other growth stocks, well, they don't pay anything because they're taking those earnings and retaining those earnings and using them to grow the business. So this is a very important common stock ratio that we just look up and don't have to bother doing. Slide number 15, the dividend payout ratio. Again, we did this in chapter 5. We take our dividends per share and divide it by the earnings per share. And that tells us how much is being paid out to shareholders in the form of dividends, how much of the company's earnings. More mature companies often pay out almost all of their earnings in the form of dividends. Why? Because they don't need the retained earnings. They don't need to grow the business. They can now be more mature, like a Microsoft, which is now paying very rich dividends because every time they rewrite Word, they screw it up even worse, or Windows, and so they got all this cash coming out of their ears. It's time to give it back to the investors. Companies, growing companies, as we said, retain those earnings to support the growth of the company. Slide number 16, book value per share. Some of you had a little hard time finding this, and you can compute it, but you got to go to the same place where you can just look it up, and that's Yahoo Statistics. You go to the company using finance.yahoo.com, and then you go to the one thing used to be called Key Statistics, and it was a whole lot better, folks. I apologize. I wrote the CEO of I told you, didn't I tell you? It's on the class website. I wrote the CEO of Verizon saying these people are goofballs. You're buying a company who are goofballs and are destroying their website, and he actually responded back. Turns out that he used to live right across the street from Southwestern College. And so hopefully they'll fix it. Who knows? But go to finance.yahoo.com, look up your company, and then look for statistics. I've tried to find it in other places, and if you find it in a more readily available place, please tell me. What happens if we were to sell off all the assets, pay off all the debts? How much money would theoretically be in our pocket? Well, it won't be, folks, because when you liquidate a company, you never get the book value. The sharks, the corporate raiders come a calling and try to scoop up whatever they can for pennies on the dollar. And so what we find is that the book value is usually far less than the market value, which makes perfect sense. That makes perfect sense. Why? Because a business is in business to make money, and if you dissolved it, it simply would not be worth what it's worth intact. And that's true of any company, folks. Pretty much any company. Slide number 17. And remember, price to book value, same idea as price to earnings. You take the market price and divide it by the book value. And now it's typically, 3 or 4 or 5, sometimes more. Many years ago, investors liked a price to book value that was 1 or maybe a little bit more than 1 because they were worried about, if the company goes bankrupt, what assets can we retrieve? But that's just not true anymore. I mean, companies like Farcebook, what do they own? Not much. They own computers and data centers, which, folks, if you tried to sell the darn things, they're already obsolete. So what do they own? Intangible assets, right? The fact that they are Facebook and that hundreds of millions of people every day go look at cat videos on it. That's why they're so their book value. I don't know. I haven't checked it, but check it. It can't be worth very much because it's just they don't own a plant with all kinds of heavy equipment and they don't own railroad cars. Or airlines or things like airplanes. So check those out. Check some of those out and see what you can find. Slide number 18, price to cash flow. Remember from chapter 6, we looked at price to earnings and then we looked at price to cash flow because, and as we discussed in this presentation, earnings are not always a good measure of how much cash is coming in the door because of depreciation and other accounting transactions. We discussed good quality versus poor quality earnings. During the internet mania, many companies were reporting record earnings. At the same time, their cash flow was negative. Their checkbook was going down. How could that be? Well, in the case, the very famous case of Lucent Technologies, they were selling. They couldn't keep this stuff on the door. I mean, it was going out the door faster than they could make it. Telephone equipment, telecommunications equipment to companies that would never make a profit. Never. They just never did. And then they all went bankrupt, and then Lucent was stuck with all the equipment because they didn't get cash for the equipment. They got an IOU, and that's why their cash flow was going down, and they almost died. But they survived. So take a look at price to cash flow and see how it differs from price to earnings. And then the last one, price to sales. Again, review. Instead of using price to earnings, price to cash flow, the internet analysts were looking at price to sales because most of the companies never generated any income. Didn't look like they were going to generate any income for the next several years. Yeah, indeed. So these common stock ratios easily computed, but more easily found by just sniffing around or going to the company's website or taking a look at Value Line. Remember Value Line? Yay. Anybody go online to Value Line? They give you some information. Check it out. For free, they'll give you some information. Then, like Morningstar, they're going to try to sign you up for $50 a month. So, it's time to sit back and go back and review what we did. And then our next presentation, make sure you have the Ford statements, the Ford financial statements, either on the screen or printed out, because then we're actually going to sit down and do some calculations. Okay? So we'll see you in our next presentation where we continue with the other financial ratios that we'll discuss in this chapter. And you'll find that the assignment for chapter 17 is pretty darn straightforward, pretty easy. But again, hopefully it piques your interest and gets you digging more and more into the companies that interest you, into their financial statements, and then into even more information about them and their competitors. And you make an informed, prudent, long-term decision about which companies you want in your portfolio, and you will be the best investors the world has ever seen. I know, I'm prone to hyperbole. I apologize. But it's sincere, folks. It's sincere. You do this, you do your, it's called due diligence often. It's called due diligence. You do your research and have your eyes open, and you're going to make good decisions. And some are going to turn out, not so good, all right. And some are going to turn out a whole lot better than you ever thought. Trust me on this. And don't reach for the sky. Every once in a while, roll the dice and reach for a Tesla or a Netflix or an Amazon. But for the most part, look at companies like Ford and Johnson & Johnson and GE and the ones we talked about, the boring companies. And I wish you the best of luck, and come back in a few years and tell me how you're doing, okay? All right, see you in our next presentation where we'll take a look in deep and more depth at the Ford financial statements and compute more financial ratios.